Have you ever pondered how to wisely navigate the labyrinth of publicly listed companies in the stock market? With tens of thousands of options, where does one begin? Think of it as being in a maze. To successfully navigate it, you need a systematic approach. Today, we're diving deep into a methodology that's been an instrumental part of my investing journey since 2013. Ever wondered how to discern between a diamond and a dud in the stock market? Do you rely on friendly suggestions or chase popular trends? Here's a nugget of wisdom from Warren Buffett. Following the crowd rarely brings riches. So let's chart our own course. Imagine this. A company's value is much like an iceberg. On the surface, there are elements that catch your eye immediately, but the real depth and intricacies lie beneath. From affordability and profitability to stability, growth, and leadership, there's a myriad of aspects to consider. Some of these elements are quick checks, while others demand more in-depth analysis. But by filtering out the less promising ventures from the start, you're saving both time and energy. Essentially, you're refining your search to spot the most golden of opportunities. Remember when Warren Buffett began his investment journey in the 1950s? He sifted through massive manuals to identify investment gems. Lucky for us, the digital age has ushered in more efficient tools. One of my favorites is TiKR.com, a comprehensive platform that offers an array of data, helping you make informed decisions. Let's dive into how to utilize it effectively. Valuation matters. Imagine you're shown a gleaming new sports car. Do you buy it immediately? No, right? The price matters. Similarly, before jumping into a stock, always ask, what's the cost? On platforms like TiKR, you can easily gauge this by filters like EV/EBIT, which helps compare the price you're paying against the earnings you're likely to get. It's not about chasing the most expensive stocks, but rather about finding value. Profitability check. A company's return on assets, ROA, can be a telltale sign of its profitability. Think of two friends, Bob and Stefan. While both own restaurants generating the same profit, Bob's establishment cost half of what Stefan paid. Naturally, Bob's return on assets is double. It's the same with companies. Higher ROA generally indicates better profitability. Growth potential. Past growth isn't always indicative of future success. While it's beneficial to lean towards companies with a positive growth trajectory, it's equally vital to steer clear of declining entities. Reliability review. You wouldn't trust someone based on a single good deed, would you? Similarly, a one-off surge in a company's earnings doesn't establish reliability. Dig deep into their financial histories and trust platforms like TiKR to provide a comprehensive overview. Lastly, don't just follow the herd. If you're searching for undervalued stocks, take the time for a thorough analysis. Maybe you're familiar with giants like Facebook or Target, but there might be lesser-known entities brimming with potential. Remember, investing isn't about following trends. It's about rigorous research and making informed decisions. The digital age of investing. With the technological advancements we have today, it's not just about picking any stock on a whim. Intelligent investors use data analytics, industry forecasts, and historical patterns to make well-informed decisions. Platforms like TiKR have revolutionized the game, but it's essential to understand that it's only as good as the user's understanding. Diversifying your portfolio. The age-old adage of not putting all your eggs in one basket holds true in investing as well. Diversification can be your safety net. By spreading your investments across a variety of sectors and regions, you can potentially reduce risk. For those just starting on their financial journey, this is crucial. The stock market will have its highs and lows, but diversification can help to even out those extreme curves. Importance of continuous learning. Financial literacy is not just about knowing where to put your money, but it's a continuous journey of learning. The world economy is ever-evolving, influenced by politics, natural events, technological advancements, and even sociological shifts. As an investor, staying ahead means always being ready to learn, adapt, and change. The power of compound interest. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." The earlier you start investing, the more time your money has to grow. Even small amounts, when given enough time, can result in substantial gains, all thanks to the power of compounding. The emotional side of investing. It's not all about the numbers and analytics. Investing is also deeply personal and emotional. Market volatility can be nerve-wracking. The key is to maintain composure. Don't be swayed by market hysteria. Remember why you invested in the first place. Stick to your strategy and avoid making decisions based on emotions. Recognize the importance of ethics. Ethical investing is becoming more relevant today. More and more investors are looking beyond just profit, prioritizing companies that are socially responsible and environmentally conscious. There's a dual benefit. You support causes that resonate with your values, and often these companies have sustainable long-term business models. A brief on global markets. Don't limit yourself to just your local market. There's a vast world out there with emerging markets offering potential growth opportunities. But as with all investments, it's essential to do your homework. Research, understand the political and economic landscape, and then invest. Why financial literacy matters. Being financially literate doesn't mean you'll never face financial challenges, but it does arm you with the tools and knowledge to navigate them. It's about empowerment, freedom, and building a secure future. If you've enjoyed this journey through the world of investment strategies and understanding the stock market's nuances, consider subscribing to Financial Literacy. We are here to ensure that you stay informed, make intelligent choices, and grow your wealth. The rise of robo-advisors. In the ever-evolving landscape of investing, technology has carved a significant niche with the introduction of robo-advisors. These automated platforms, driven by algorithms, provide investment guidance based on an individual's risk tolerance and financial goals. As a digital-first approach, robo-advisors offer lower fees than traditional financial advisors and are accessible 24/7. But like all tools, it's crucial to understand their limitations. While they provide an easy entry point for new investors, one must remember they lack the personal touch a human advisor can offer. Emotional intelligence, nuanced understanding of a client's unique situation, and personal rapport often matter in complex financial decisions. For many, a hybrid approach seems optimal. Using robo-advisors for a base portfolio and consulting human advisors for more intricate financial planning can harness the best of both worlds. In the rapidly advancing age of tech, it's all about strategically merging the computational power of machines with the emotional intelligence of humans. If you're finding this content valuable, don't forget to hit the subscribe button for more insightful financial tips from Financial Literacy. As we conclude, take a moment to click the like button if you found this beneficial. Together, let's navigate the world of finance with ease and wisdom.